Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice.
And it's 10 p.m. Pacific on Tuesday, August 29th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, we delve into the SEC's latest crackdown on NFTs, what it means for the future of non-fungible tokens. We'll also examine the legal quagmire that Sam Bankman-Fried finds himself entangled in. On the political front, the GOP is locking horns with the Federal Reserve over crypto regulations. We'll unpack that. Binance is navigating a complex regulatory landscape across nations. We'll break down their latest maneuvers. Then we'll discuss Digital Currency Group's big Genesis deal and what that means for the broader crypto ecosystem. And finally, we'll contrast Bitcoin adoption in El Salvador and Argentina. Two countries, two different stories. Buckle up, we've got a packed show tonight. The Securities Exchange Commission made a landmark move. Impact Theory is a LA-based media company. Well, the SEC has charged Impact Theory with some serious offenses. The company raised about $30 million. How? By offering NFTs. The non-fungible tokens were divided into 3 tiers and given fancy names like Legendary, Heroic, and Relentless. Impact Theory told buyers that owning these NFTs was akin to investing in the company. If the company hit it big, so would the NFT holders. The SEC wasn't buying it. They said these NFTs are actually investment contracts. That makes them securities under the law, and securities have to be registered. Impact Theory hadn't done that, so they were in violation of federal laws. The company didn't fight the SEC's charges. Instead, they agreed to a cease and desist order. They'll be paying a hefty sum, too, over $6.1 million in penalties and other charges. To make things right with the buyers, a fair fund will be set up. This fund will repay the affected investors. Also, the founders' keys NFTs that Impact Theory controls will be nullified. Now, what's critical to understand is the broader picture this paints. This isn't just a one-off penalty. By its very nature, it's a precedent. The SEC's actions against Impact Theory signal a more aggressive stance regarding the NFT market. Antonia Apps, who's in charge of the SEC's New York office, was clear. Any offering of securities has to be registered, no exceptions. Either way, this case is a wake-up call for the NFT world. There are many other projects out there offering NFTs as a form of a company share. This could make them the SEC's next targets. This case sets a precedent. It's likely the first of many actions against NFT projects. But not everyone at the SEC is singing the same tune. Commissioners Hester Peirce and Mark Yayeda have publicly disagreed with this action. They question the SEC's application of the Howey analysis to NFTs, suggesting the commission may be jumping the gun. Moreover, it's important to consider the ripple effect of this case on the broader crypto landscape. The SEC's move has triggered responses from the crypto community. Many are concerned that it could stifle innovation in the NFT space, adding another layer of uncertainty to an already turbulent market. The SEC's actions could be a double-edged sword. On the one hand, it aims to protect investors. On the other, it could hamper the growth of a nascent industry. The crypto community is alarmed. They see this as an overreach by the SEC. It could deter creators from launching new NFT projects. The lack of clear rules adds to the confusion, leaving the community in a state of uncertainty. In the end, the SEC's actions against Impact Theory is a pivotal event. It ignited a debate that's far from over. The dissent by Commissioners Peirce and Yayeda also fuels this debate. It questions the SEC's readiness to regulate the complex world of NFTs. The SEC's actions and subsequent dissent among its own ranks reveal that we are in the early stages of defining what NFTs are in the eyes of the law. This is a story that's still unfolding, and one that could have far-reaching consequences for the crypto world, for better or worse. If you think the SEC is only zooming in on NFTs, think again. Let's pivot to another legal maze. Sam Bankman-Fried is in hot water, so don't forget to hit that follow button to stay updated on these unfolding dramas. By now, it's widely known that Sam Bankman-Fried is facing serious legal challenges. His lawyers are scrambling for his temporary release, but the Department of Justice is holding its ground. The trial is slated for October, and the DOJ has made a strong move to bar all of SBF's expert witnesses. His legal team is protesting, but the DOJ argues that the law must be upheld. The government recently released 4 million pages of new evidence, SBF's lawyers are crying foul, but the DOJ maintains that this is a part of due process. The defense claims this violates the SBF's Sixth Amendment rights, but the government argues that justice must be thorough and impartial. Judge Lewis Kaplan revoked SBF's $250 million bail last month, a decision that has been appealed by his lawyers. Now, let's look at the details. The DOJ's actions may seem harsh to some, but they are in line with ensuring a fair and just trial. The release of millions of pages of evidence might be overwhelming, but it's crucial for transparency and thoroughness in a case of this magnitude. The move to bar expert witnesses is not an attack on the defense, but a safeguard against potential bias. SBF's legal team is doing what any defense would do: fight for their client. However, the DOJ is tasked with upholding the law, and they are doing so with vigor. The limitations on SBF's computer access and the revocation of his bail are not tactics to undermine him, but measures to ensure the integrity of the trial. This case is more than just a legal battle for one individual. It's a litmus test for how the U.S. legal system interacts with the burgeoning crypto industry. The DOJ's actions send a clear message: no one is above the law, not even major players in the crypto world. This case could set important precedents, and the DOJ is making sure those precedents uphold the principles of justice and fairness. Legal battles aren't just for crypto entrepreneurs. Even politicians are rolling up their sleeves. The GOP is in a tug-of-war with the Federal Reserve. You want to stay in the know? Make sure you're subscribed and getting notifications. The Federal Reserve issued two supervision and regulatory letters, SR 23-7 and SR 23-8. These two letters have sparked controversy. The letters aim to enhance oversight into crypto-related activities at American banks. Republican members of the House Financial Services Committee, including Patrick McHenry and French Hill, have criticized these actions. They argue that the Fed's moves undermine Congress's efforts to establish a regulatory framework for stablecoins. The lawmakers have sent a letter to Fed Chair Jerome Powell, expressing their concerns and asking for clarification. The House Financial Services Committee previously advanced a comprehensive regulatory framework for stablecoins in the United States. However, the bill's prospects of it becoming law were doubted after negotiations between Congressional Democrats, Republicans, and White House broke down last week. The lawmakers assert the Fed's actions could deter financial institutions from participating in the digital asset ecosystem. They also point out that the letters were not issued in compliance with the notice and comment process required by the Administrative Procedure Act. The Federal Reserve's recent actions have set the stage for a showdown with Republican lawmakers. This isn't just a bureaucratic squabble. It's a battle for the future of digital assets in the United States. The GOP's strong pushback indicates a deep-rooted distrust of centralized authority, especially when it comes to financial freedom and innovation in the crypto space. The Fed's actions could have far-reaching implications. By setting up roadblocks for financial institutions, they're not just stifling innovation, they're potentially hindering the U.S. from taking a leadership role in the growing digital asset market. This could be a strategic misstep at a time while other nations are advancing their own crypto initiatives. The GOP's resistance is more than just political posturing. It's a stand for financial freedom, innovation, and a decentralized future. The Fed's unilateral actions, without proper compliance with legislative procedures, only fuel the perception that central banks are not to be trusted. From the U.S. corridors of power to global hotspots, Binance is jumping through regulatory hoops in Belgium and Russia. If you value financial freedom, tap that like button now. Binance is making strategic moves in Belgium and Russia. In Belgium, Binance is redirecting its users to its Polish subsidiary. This move comes after the Belgian Financial Services and Markets Authority ordered Binance to shut down its services. The regulator gave Binance the option to transfer its Belgium users to entities regulated under the law of an EEA member state. Binance chose its Polish subsidiary for this purpose. The subsidiary is registered as a virtual asset service provider in Poland. Users may need to resubmit some KYC documentation to comply with Polish regulations. Binance's decision to use its Polish arm to serve Belgian users is a calculated move to dodge regulatory bullets. It's a workaround, a way to keep the business running while staying within the bounds of the law. But let's not forget, this is a temporary fix. The crypto industry in Europe remains largely unregulated, at least for now. And Binance's Polish entity is not subject to any prudential requirements. So while Binance may have found a loophole, it's not a long-term solution. In Russia, Binance is considering a full-on exit. This comes amidst allegations of helping nationals move money abroad and non-compliance with U.S. sanctions. Binance has restricted trading in P2P operations involving sanctioned Russian banks and limited its Russian P2P trading service. The exchange is also facing multiple lawsuits with US regulators. So what's the takeaway? Binance is walking a tightrope of regulatory compliance, not just in one country, but globally. The moves in Belgium and Russia are indicative of a larger issue, the ongoing battle for crypto exchanges to operate within the confines of the ever-changing and often unclear regulations. It's a high-stakes game, and Binance is making its moves carefully, but how sustainable is this strategy in the long run? Only time will tell. Speaking of financial maneuvers, Digital Currency Group is making waves with its Genesis deal, an agreement that could set new standards. Hit subscribe to follow along. Digital Currency Group and Genesis Global have reached an in-principle agreement. This aims to settle the bankruptcy claims against Genesis. The deal could resolve over $3.5 billion that Genesis owes to its top 50 creditors. Among these creditors is the Winklevoss twins exchange Gemini. DCG has a plan to clear its existing debts. These debts include around $630 million due by May 2023. There's also a $1.1 billion promissory note due in 2032. The repayment plan is divided into two parts. The first is $328.8 million due in 2 years. The second is $830 million due in 7 years. DCG is also committed to an additional $275 million. This will be paid in 4 installments. Unsecured creditors could see a recovery. This ranges from 70 to 90% in US dollars. In terms of digital assets, it's between 65 and 90%. This agreement is a pivotal moment. It's crucial for both DCG and Genesis, and by extension the crypto sector. The deal is a complex legal maneuver. It aims to navigate the murky waters of crypto insolvency, but it's not without its hurdles. Key players like Gemini have not yet supported the deal. This raises questions about its viability. If the deal goes through, it could set a precedent. This would affect how crypto companies handle insolvency and creditor claims. The outcome could either stabilize or disrupt a volatile market. As we watch the space, one thing is clear. The crypto world is increasingly entangled with traditional financial and legal systems. This could be for better or worse. While companies make deals, countries are taking different paths on Bitcoin. Let's compare El Salvador and Argentina. If you're into geopolitical crypto shifts, don't forget to like and subscribe to stay informed. El Salvador made headlines by declaring Bitcoin legal tender. Despite this, adoption has been slow. The Central Bank of El Salvador granted 2 licenses to Binance for crypto services. Guillermo Contreras, CEO of Dito Banks, aims to solve this by creating Bitcoin-based savings and loan products. Contreras is targeting the 70% of Salvadorians who are unbanked. The government's Chivo wallet gave each citizen $30 in Bitcoin, but most converted it to fiat. Dito Banks offers MasterCard debit cards that can convert Bitcoin to USDC to mitigate price volatility. In Argentina, Bitcoin adoption is outpacing El Salvador. ARK Invest notes that Argentina's soaring inflation and a pro-Bitcoin presidential candidate are fueling this. Argentina's inflation rates are predicted to reach 147% in 2023. Javier Milei, a pro-Bitcoin candidate, has risen in prominence. His victory in the primaries led to a 20% increase in Bitcoin's price in Argentina. El Salvador's move to make Bitcoin legal tender was groundbreaking, but adoption is lagging. The government's efforts, like the Chivo wallet, haven't been enough to spur mass adoption. Dito Banks is stepping in to fill the gap, but it's a slow process. The Salvadoran population's preference for the US dollar and the complexity of using Bitcoin are significant barriers. In contrast, Argentina is embracing Bitcoin at a much faster rate, driven by economic desperation. Inflation is through the roof and the people are looking for alternatives. The rise of Milei has added fuel to the fire. If Milei wins the upcoming election, it could be a game changer for Bitcoin adoption in Argentina and possibly the rest of Latin America. The tale of these 2 countries reveals the complexities of Bitcoin adoption. It's not just about legal status, it's about economic conditions, political will, and public sentiment. While El Salvador struggles to move beyond the initial hype, Argentina is leveraging its economic woes to fast-track Bitcoin adoption. So what happened? In our first segment, we explored how the SEC is taking a hard line on NFTs, charging impact theory with securities violations. This sets a precedent, signaling the SEC's intent to bring regulatory scrutiny to the NFT market. Then we delved into the legal challenges facing Sam Bankman-Fried. The DOJ has thrown the book at him, setting a tone that no one in the crypto industry is above the law. We also looked at the GOP's pushback against the Federal Reserve's crypto regulation initiatives. The battle lines are drawn, and it's clear that the future of crypto in the US hangs in the balance. In our story about Binance, we saw how the crypto exchange juggles regulatory hurdles in Belgium and Russia, attempting to stay afloat while adhering to the law. A challenging path, but how long can they sustain it? Digital Currency Group's agreement to settle Genesis Global's bankruptcy claims could set a new standard for dealing with insolvency in the crypto world. It's a complex deal, and its success is still uncertain. Lastly, we compared Bitcoin adoption in El Salvador and Argentina. While El Salvador's government-led adoption has been sluggish, Argentina's public has embraced Bitcoin in response to economic turmoil. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.